Top analysis on major stock market indicators, VIX, TNT, oil prices, yield curve inversion. Also, buckle up for deflation, we will dive into that as well. On September 6, 2024, major indicators started to break out from a long trend, so, in this video, right away, I will present to you on the charts how these breakouts happened, with an update from September 13th. Then we are going to talk about what usually happens when those indicators move, and what it means for the US stock market. But, if you want to check some very interesting data, stick until the end. Because we will explore the relationship between what happened in the stock market after September of 2000 and 2007, when the Fed also decided to cut rates back then, and try to relate to the current time, since on September 18th, next Wednesday, the Fed is expected to cut rates. But there is more. We will also bring attention to the current deflation fear that came up on September 11th, after last report stated the lowest annual CPI rate since early 2021. First, let's go right to the chart and make a quick overview of the indicators, and then follow with the top analysis. As you can see on the daily chart, the VIX, on a long downtrend, broke out from the trend line that started on February 2020, has retested and reacted on the trend line, but came back for another retest on the support from the broken trend line. VIX is still holding above the trend line and is signaling that it has shifted to an upward movement, and later in this video, I will show you what happened to VIX in 2007 before the market crash. Now, let's show you the TNT, or the 10-year US Treasury notes chart. As you can see, the bearish trend line that started on September 2020 has been broken and is not showing any sign of weakness, since it kept going up during last week until last Friday, which signals a shift from bearish to bullish momentum. Could this mean that big investors are getting into risk-off mode? We will expose this related analysis later on. The oil breakout surprised investors, since it broke below the rising wedge triangle and is not showing any sign of a reversal to the upside yet, and could be searching for the lower support at $45. Later in this video, we will explain why this downturn happened, so stay tuned. Also, if you are enjoying the content, please press the like button, so we can keep sharing special information with you. And, last but not least, the yield curve inversion, which is the negative relationship between the 10-year and the 2-year yield from the USA Treasury, broke out the long trend and is now in positive territory, and from last week's consistency, seems to show that this time the uninversion was official, not showing any sign that it wants to go back to the inversion territory, currently sitting at 1.020%. When the 10-year is below the 2-year yield, it means there is a yield curve inversion because in normal circumstances the 10-year yield is supposed to be higher than the 2-year yield. Since the longer you have to wait, it would involve more risks. In August, there was a quick uninversion back into positive territory, though not holding for long. But in September 6th, the uninversion happened differently, because it is still holding strong in positive territory as of Friday, September 13th. As you can see on the daily chart, it has retested, and then reacted from the area, showing a strength not seen for some time, and that could mean that this time is for real, and that officially the uninversion has happened. Historically, this signal has often preceded economic downturns, as seen prior to the 2001 recession, the 2008 financial crisis, and the Great Depression in 1929. In each case, after the yield curve uninverted, it was followed by a substantial economic slowdown. The yield curve serves as a gauge of how financial markets view the labor market's condition. When inverted, it reflects a strong labor market, often occurring alongside the Federal Reserve's tightening policies through higher interest rates. On the other hand, as the curve uninverts and steepens, it suggests the Fed is loosening monetary policy in response to a cooling labor market and rising unemployment. As you can see on the chart, current unemployment data seems to be gaining momentum. This pattern is playing out once again as the yield curve steepens while unemployment rises. This situation heightens concerns about a possible recession, which could further steepen the yield curve and drive unemployment higher. If this pattern persists, additional market downturns driven by recession fears could be on the horizon. Periods of prolonged yield curve inversion often lead to severe market corrections, such as the 1974, 2008, and 1929 crashes. Today, we are positioned for potential market weakness, which could trigger a substantial decline once a recession sets in. Currently, the yield curve has been inverted for a record 793 days, about 26 months, without a recession. Recessions usually follow within 6 to 24 months after yield curve inverts. Historically, 5 out of the 6 US recessions since 1980 were preceded by yield curve inversions lasting at least 20 days, with the exception being the brief inversion in August 2019, which preceded the pandemic-driven 2020 downturn. While it may be tempting to dismiss recession fears once the yield curve normalizes, history shows that the real trouble often starts after prolonged inversions end. The last 4 recessions, in 1990, 2001, 2007, and 2020, each began 3 to 6 months after the yield curve uninverted. Let's dive into oil top analysis. Crude oil erased their 2024 gains this month, as concerns over a global economic slowdown weighed on markets, also influenced by the recent CPI data, which signaled a deflation, since it came up, on September 11th, as the lowest annual CPI rate since early 2021. This deflation fear and the current CPI data could lead to lower oil prices as an economic slowdown typically reduces oil demand. In response to the oil slump, the Organization of the Petroleum Exporting Countries and its allies announced that they would extend voluntary production cuts of 2.2 million barrels per day until the end of November. The VIX breakout and the stock market. VIX was on a long downtrend since February 2020 and broke out in late August. In times of market volatility, the VIX often spikes higher, reflecting increased demand for puts as investors hedge against further declines. But what could have triggered this current breakout? The recent sharp drop in the S&P 500, and the market, in general, has caused the VIX to spike sharply, indicating that the fear gauge is back in spiking mode. What happened to the S&P 500 in 2007, when the same type of VIX breakout occurred? As you can see, on the chart from 2001 to 2008, VIX was on a long downtrend since September 2001. Then, in March of 2007, VIX broke out, retested, and reacted from the trend line, very similar to the current breakout. Later on, in October 2007, the S&P 500 started to crash, dropping around 56%, until March 2009. Could this mean that the US stock market crash is near? We cannot confirm it yet, but we need to keep a very close look at this VIX reversal signal, because if this becomes a clear uptrend, it certainly means that the stock market crash will happen. Conclusion: VIX indicator remains mixed, but recent moves have issued a warning to the stock market bulls, and if VIX keeps on an uptrend, it could be a signal for an imminent stock market crash. Now, let's dive into TNT top analysis. Instead of being good news from lower rates expectations, in contrary, could mean that big investors are now getting into risk-off mode. As you can see on the chart, the bearish trend line that started on September 2020 has been broken and is not showing any sign of weakness, since it kept going up until last Friday the 13th. The last CPI data from September 11th exposed a new reality on the current US deflation, and heightened the fear of a looming recession, which is spreading on Wall Street. So, could this breakout mean that big players are getting ready to shift, all the way from the stock market risk-on, to bonds on a risk-off sentiment? Stocks have the potential for higher returns compared to bonds, but they also carry greater risks. Bonds, on the other hand, typically provide more stable returns, making them a better choice for investors who prefer to minimize risk. Understanding deflation, what it is and could it benefit consumers? First, it is crucial to break down the definition, because, contrary to inflation, deflation is when prices fall for certain goods and services. Typically, deflation in the US economy happens during periods of recession, experiencing stable or positive price growth. Changes in consumer prices are tracked by comparing a basket of goods and services to an index, with the Consumer Price Index being the most widely used in the US. A drop in the CPI from one period to the next signals deflation, or a general decline in prices. This can benefit consumers by boosting their purchasing power, allowing them to buy more with the same amount of money. However, rapid deflation can sometimes lead to short-term economic contraction, especially when an economy is heavily dependent on credit and speculative investment. If the availability of credit shrinks, asset prices fall, and overinvestments are liquidated, triggering a cycle known as debt deflation. This process can temporarily reduce economic activity as debt burdens rise relative to the value of assets, and financial institutions become more cautious about lending. Deflation occurs when the supply of goods and services outpaces the supply of money or credit in an economy. It can be driven by technological advancements, resource discoveries, or productivity increases, which tend to raise living standards by increasing consumers' purchasing power. While there are concerns that falling prices might lead consumers to delay purchases, most essential goods and services, such as food, housing, and healthcare, cannot easily be deferred. Deflation primarily affects sectors where large debts are incurred, as falling prices increase the real value of fixed debts. If the US economy is not in a recession, how could it be experiencing a deflation? The US has not yet entered a confirmed recession, according to economists, but consumer prices have fallen in certain categories like cars, household furniture, appliances, airfare, and some groceries since August 2023. Inflation reached its lowest level since February 2021, marking a cooling trend that has been ongoing since the pandemic began. This slower rise in prices, known as disinflation, reflects a general decrease in the rate of inflation while average prices continue to rise, just at a slower pace. Despite this overall trend of disinflation, there are areas experiencing outright deflation, where prices are falling instead of rising. Deflation has been noted in the prices of physical goods, including cars and household appliances, as well as gasoline and some groceries. These isolated instances of price drops are unusual in a non-recessionary period, as deflation is typically associated with economic downturns. Economists are cautious about declaring a broad, sustained drop in prices across the US economy, as deflation usually signals recessionary conditions. While the recent Consumer Price Index report shows signs of deflation, the US economy is not officially in a recession. Economists are now watching closely to see how these deflationary trends will be explained and what they might mean for the broader economic outlook. Since August 2023, core goods prices, excluding food and energy, have decreased by about 2%, with a 0.2% drop from July to August 2024, according to CPI data. This deflation in goods prices is largely attributed to the normalization of supply and demand trends that were disrupted during the pandemic, explained Stephen Brown, Deputy Chief North America Economist at Capital Economics. During the early pandemic, demand for physical goods surged as consumers, confined to their homes, redirected spending from experiences like travel and dining out to household items, while supply chain issues slowed the availability of these goods, driving up prices. Now, with those supply and demand pressures easing, prices have deflated as supply chains have improved and consumer spending habits have normalized. The pandemic-driven economic distortions that caused price spikes have largely corrected, leading to a reduction in goods prices. Economists also point to long-term trends like globalization, which increases the supply of lower-priced goods from countries like China. Since August 2023, prices have deflated across various consumer goods categories, according to CPI data. Furniture and bedding prices have dropped by 5%, while appliances and tools are down by 3%. Toys and apparel have seen similar decreases, with men's suits and outerwear falling by 10%, women's outerwear by 9%, and footwear by 1%. Additionally, airline fares have fallen by about 1%, partly due to a 21% drop in jet fuel prices, making air travel more affordable. Vehicle prices have also seen significant declines, with used cars down by 10% and new cars by 1%, while rental prices for cars and trucks have dropped by 8%. Several factors contribute to these declines, including an improved inventory of vehicles, reduced consumer demand due to higher financing costs, and a strong US dollar, which makes imports cheaper. Grocery prices for items like apples, potatoes, coffee, rice, seafood, and bananas have also declined, though each item has unique supply and demand influences. Some deflation, especially in categories like electronics, may appear on paper due to quality adjustments made by the Bureau of Labor Statistics. For example, as electronics like TVs, cell phones, and computers improve, consumers receive more value for the same price, which is recorded as a price decline in CPI data. Deflation and the economy-wide debt bubble fueled by central bank. A small amount of deflation can be a natural result of economic growth and can benefit the economy. However, when deflation follows an economy-wide debt bubble fueled by central bank policies, it can lead to a financial crisis and recession. This type of debt deflation occurs when rapid price declines follow the bursting of the bubble. Although this period is temporary, it could be avoided entirely if central banks resisted inflating the money and credit supply in the first place. The real danger lies not in deflation itself, but in the inflationary policies that create debt bubbles, leading to deflation when they burst. Over the past century, repeated inflationary cycles fueled by central banks have become common, making deflation often associated with economic damage. Economists are now cautious in interpreting current deflationary trends, as they typically occur during recessions. Therefore, the US is not officially in a recession, but this has led to close scrutiny of recent data to determine what the trends mean for the future US economic outlook. Don't miss out on the video above. Thanks for watching. Good luck and good profit, by Edward Cash Trader. Please read the disclaimer in the description below.